Welcome to The Debate. Let's go back for a moment to October 10th, 2025. If you were looking at a chart that day, you saw a red candle. But if you were inside the plumbing of the global financial system, you felt an earthquake.
It certainly wasn't just standard market volatility.
No, it wasn't. It was a stress test for the entire infrastructure of modern capital. In a matter of 4 hours, $20 billion was liquidated from the global markets. It was violent, it was sudden, and on that day, the giants of the industry, the centralized exchanges that had acted as the gatekeepers for a decade, they didn't just stumble, they froze.
Right, I remember the maintenance mode notifications, the inability to log in, the sheer panic.
Exactly. Screens went black, but amidst that wreckage, while the emperors of the industry were pulling the plug to save their servers, something else was happening in the background. A new system operating without a CEO, without a headquarters, and without permission processed every single transaction without a millisecond of downtime.
It was a dramatic day, certainly. But, well, we have to be careful with the history we're writing here. You look at those events and you see a revolution against the empire. I look at the same data and I see a changing of the guard, funded by the largest war chest in history. We're analyzing the silent war between Binance, the established hegemon, and Hyperliquid, the insurrectionist protocol.
And the central question we are debating today is this: was 2025 the year the empire finally cracked? I am arguing that we witness a definitive structural end to the era of centralized exchanges. This wasn't just luck, it was driven by superior technology and a user revolt against custodial control.
And I approach this from a completely different angle. I argue that this supposed revolution was actually a mercenary migration fueled by the largest financial incentive in the history of this space, the airdrop. We need to question whether this shift is ideological or if it is merely opportunistic. I mean, if you pay people enough, they will overthrow any government you want. That doesn't mean they believe in the new one.
I think that's a slightly cynical view, but let's unpack it. To understand October 2025, we really have to look at the signals leading up to it. If you were paying attention to the quarterly reports and the on-chain data in early 2025, the emperor Binance was already acting strangely. For years, their rhetoric was purely about domination, expansion, volume. They were the sun the entire market orbited around. Then suddenly, the language shifted.
They pivoted to compliance. They started talking about user protection and regulatory frameworks.
Right, but look at the timing. Why then? And look at their actions, not just the press releases. Suddenly, trading fees were slashed across the board. Listings for new tokens, which used to take months of rigorous vetting, were being rushed out in days. They were listing rapidly, almost desperately. These weren't random business decisions. These were defensive maneuvers.
Defensive against what exactly?
They were reacting to a threat they couldn't name publicly because to name it would be to legitimize it. They were terrified of the perpetual DEXs, the decentralized exchanges.
I think you're reading a lot of geopolitical intent into what is basically standard market competition. Binance was facing massive existential pressure from the SEC and global regulators. That pivot to compliance wasn't fear of some small, decentralized protocol. It was fear of being shut down by the US government.
Now, as part of it, sure, but the regulators attacked the legal structure. The DEXs were attacking the business model itself. The centralized model was losing its monopoly on trust. We need to explain what trading with leverage actually looks like to understand this. Usually you need a bank, or in this case, an exchange, to lend you the money to make a big debt. You deposit $1,000, they let you trade with $10,000. But to do that, they hold your keys. They hold the cash. They are the absolute custodian.
Which is how finance has worked for 400 years, efficiently.
Until it isn't efficient. What Hyperliquid did was put that lending logic into code. The bank wasn't a corporate entity anymore. It was a smart contract. And in 2025, users started realizing they didn't need the middleman. The core value proposition of a CX, we hold your money so you can trade fast, was collapsing.
I'm sorry, but I just don't buy that it was purely about trust or custody. You're describing a philosophical awakening, a moment where the masses suddenly cared about their private keys. I see a gold rush. I see greed. Hyperliquid didn't win just because the tech was better or because people wanted freedom. They won because they printed money.
You're focusing on the result, not the cause. But let's hold on the incentives for a moment. We have to understand the battlefield. Because if the tech didn't work, the money wouldn't have mattered.
Fair enough, but let's be realistic about the tech. For years, decentralized exchanges were a joke.
They were early. If we look at the history, go back to 2021, the wilderness years. You had protocols like DYDX. The ideas were right, but the execution was painful. You were trying to run a high-speed trading engine on Ethereum Layer 1.
It was slow. It was incredibly expensive. You'd pay $50 in gas fees just to open a trade, and then wait 15 seconds for it to confirm. In high-frequency trading, 15 seconds is an eternity. It's not a product, it's a charity.
Exactly. It was a proof of concept. But while the market was quiet in 2022 and 2023, while prices were down and the tourists left, the infrastructure quietly matured. This is the part people miss. Hyperliquid didn't just build a copy of DYDX. They realized you can't build a NASDAQ on top of a general-purpose blockchain like Ethereum, which is trying to do everything from art to gaming. It's like trying to run a Formula One race on a busy highway during rush hour.
So they built their own track.
They built a dedicated Layer 1 blockchain specifically optimized for one single thing, trading. By late 2024, the technology had become invisible. You click the button and the trade happened instantly. No gas fees, no waiting. Millisecond latency. This was the turning point. The user experience finally matched the centralized exchanges.
I will grant you that the engineering was impressive. They solved the latency issue. But having a fast car doesn't mean you win the race if you don't have any gas. And this is where I have to insist on the economic reality. You can have the best engine in the world, but Hyperliquid poured jet fuel on the fire. We cannot ignore the numbers in the analysis.
The distribution?
The bribe? Let's call it what it actually is. Hyperliquid allocated 300 million tokens for their airdrop. To put that in perspective, when Uniswap, the grandfather of DEXs, did their airdrop, it went to about 2,500 addresses. It was a niche gift. Hyperliquid targeted 94,000 portfolios.
It was a community distribution meant to decentralize the network.
It was a stimulus package that would make a central banker blush. The wealth transfer was staggering. According to the data, 12% of those wallets received between 5,000 and 10,000 Hype tokens. In dollar terms, at the peak, that is between $140,000 and $240,000.
Wow.
For one person, just for using a website.
It's a significant amount of value, yes.
Significant? It's market distorting. It creates a completely fake economy. People weren't trading on Hyperliquid because they loved the protocol's architecture or because they deeply cared about self-custody. They were trading because they were mining points. They were washing volume to increase their payout. This wasn't organic growth. It was a mercenary army rented for the season.
I'm not convinced by that line of reasoning because it ignores how that value was created in the first place. Look at the alternative. In the traditional tech model, or even the early crypto model, you have venture capitalists. They put in the money, they own 40% of the network, and then they dump their tokens on the retail users 3 years later.
And you think this is fundamentally different?
I do. There were no VCs here, no early investors extracting value. That $240,000 didn't go to a firm in Silicon Valley. It went to the actual users who provided the liquidity. It was an alignment of incentives. They essentially said, if you provide the liquidity that makes this market work, you own the market. That isn't a bribe. That is a cooperative.
It's a beautiful narrative, I admit. The people's exchange. But I look at human nature. You can buy loyalty for a while, but what happens when the money runs out? That's the real question. But before we get to the aftermath, we have to talk about the conflict itself. Because as you mentioned earlier, the empire didn't just sit back and watch this happen.
No, they fought back. And this is where the story turns into a thriller. We saw what can only be described as a shadow war.
We have to be careful with terms like war. We have allegations of market manipulation.
The patterns are undeniable, though. During the rise of Hyperliquid, right before the big crash, we saw strange tokens with very low liquidity being listed on the platform. These weren't standard assets like Bitcoin or Solana. These were small, illiquid coins. The theory, which is widely supported by on-chain forensics, is that large entities allegedly connected to the giants like Binance or Bybit attempted to manipulate these prices to break the system.
You're referring to the bad debt attacks? We should explain how this actually works because it is a very specific type of financial violence.
It is. Here's the mechanism. You find a tiny, obscure token with very little trading volume. You buy a massive amount of it on the spot market to jack up the price artificially, say pumping it up 500% in an hour. Now, according to the Oracle, the system that tells the blockchain what the price is, that token is incredibly valuable.
Right, so you take this inflated, essentially garbage token and use it as collateral.
Exactly. You deposit this valuable token into the protocol and use it to borrow millions of dollars of real assets, USDC, hard cash. Then you dump the garbage token. The price crashes back to zero, you walk away with the millions in cash, and the protocol is left holding collateral that is now worth absolutely nothing. The protocol becomes insolvent. It's a bank robbery, but you use math instead of a gun.
And this is a standard weakness in decentralized finance. It has killed countless exchanges before.
That was the intent, to bankrupt the insurance fund, to create so much bad debt that the system would collapse, proving to the world that decentralization doesn't work, proving that you need a corporate custodian to stay safe.
But it didn't work.
No, it didn't. And that is why this moment matters. Hyperliquid absorbed the toxic debt. They didn't halt trading. They didn't roll back the chain to save themselves. They publicly accused the giants of collusion. This was the moment the Cold War turned hot. It showed that the protocol could withstand a targeted financial attack from the deepest pockets in the industry.
I will concede that their survival of that period was impressive. It proved the risk engine was genuinely robust. But surviving an attack is one thing. Surviving the market itself is another. The real test, the one that changes history, wasn't the shadow war. It was the crash.
October 10th, 2025.
The day the floor fell out.
Let's re-examine that day. $20 billion liquidated globally. In a crash of that magnitude, the order books move so fast that traditional database architectures simply struggle to keep up. We saw it happen. The centralized exchanges, with all their server farms and thousands of engineers, couldn't handle the throughput.
To be fair, putting an exchange into maintenance mode during a crash is often a protective measure. It prevents further cascading liquidations. It saves users from being wiped out by a single momentary price wick.
That is the corporate spin. But if you are a trader and you want to close your position to save your capital and the sell button is grayed out, that isn't protection. That is a hostage situation. It's the bank locking its doors while the building is on fire.
And Hyperliquid?
The code kept running, no downtime. The funding rates adjusted, the liquidations fired, and the solvency remained perfectly intact. Users could enter, users could exit. It was brutal, but it was functional.
This is where I have to give ground. This wasn't about marketing or airdrops anymore. This was a stress test of the architecture under extreme load. The decentralized exchange proved it was more resilient than the centralized exchange. That is a hard fact.
And the market reacted to that fact. The statistics from the end of 2025 tell the story. DEX perps captured between 10 and 25% of the global market. That is a massive revenue drain from Binance. We are talking about hundreds of millions of dollars in fees that simply vanished from their balance sheets.
It is a structural displacement, I agree. The monopoly is broken, but I remain cautious about the future. You seem to think the war is over and the good guys won. I think we are just entering a new phase of complexity.
How so?
The narrative of Hyperliquid is self-sustaining right now because everyone made money. But look at the psychology of the user. We talked about airline miles earlier. If I fly United, I get points. I'm loyal because I want the upgrade. But if United gives me equity, actual stock, I view the company differently. Hyperliquid gave them equity.
Which makes them owners.
Perhaps. But history shows that when you give owners a chance to cash out, they usually do. The data shows that once an airdrop is claimed, retention often drops. The market has evolved, yes, but human nature hasn't. Users go where the rewards are. If Binance launches a massive incentive program tomorrow, or if a new DEX comes along with an even bigger airdrop,
Does this mercenary army stay loyal?
That's an interesting point, though I would frame it differently. I don't think they can go back. The genie is out of the bottle. The precedent is set. No VCs, fair launches, and non-custodial trading are now the standard, not the alternative.
Standards change.
But expectations don't. Once you have tasted what it means to be the bank, to earn the fees rather than pay them, to see the absolute transparency of the code, can you really go back to the black box? Can you go back to trusting a CEO who might be mingling your funds in the background?
The geopolitical reality of this space has certainly changed. The volume has moved, and a significant portion isn't returning to the corporate servers. The empire of the centralized exchange is not dead, but it is no longer the hegemon. It has to compete now, and it has to compete against code that doesn't sleep, doesn't steal, and doesn't ask for permission.
A sobering thought for any CEO in this space.
Indeed.
As we close out this analysis of the 2025 war, we have to look forward. The structural displacement has occurred. The technology works. The incentives have been proven.
We agree on that. The landscape is irrevocably changed.
And that leaves us with one lingering, powerful question for everyone listening. Now that the users have tasted the power of ownership and survived the crash without the gatekeepers, will they ever consent to being just customers again?